Troy Kearns, real estate investor, and today I'm really gonna go against the grain today. I'm gonna talk about the negative side of 401ks, what you need to be aware of. Make sure you watch the whole video in its entirety, and let's get into it right now. Negatives, 401k. How do these things go hand in hand? Why is Troy talking about this? Well, have you heard of the term golden freaking handcuffs? Typically in the United States, a 401k is an investment designed by your employer, do some sort of investment with you as an employee in order for you to build your income with them matching. That is what a 401k is. And one interesting factoid that you might find is that the 401k is actually named after the US tax code of where it came from. The employee who agrees to get into the 401k agrees to take a percentage of his paycheck and put it directly into the investment vehicle. And then the employer or your boss can match all, some, or none of it. The employee gets a number of options for investment, but most of them are just mutual funds. And the 401k was designed by Congress in order to encourage employees to save money for retirement. Some of their benefits are tax advantages. A traditional 401k is deducted by the employee's gross income. Then the employee's taxable income is reduced by the amount that they invest, and their 1099 is reflected in that because the rest is not taxed. It's invested. Get it? There's no money paid on taxes on your investments ever. Not on the profits ever. Until you take it out. Right now it's growing tax-free as you invest it, but when you take it out, that's when Uncle Sam takes a big chunk out of your butt.
Where's all your money gone, Daddy?
Taxes.
Now that we've talked about traditional 401ks, let's talk about a non-traditional 401k. A Roth 401k, and it's very similar to a Roth IRA. It just means that the taxes are taken off up front. So a Roth 401k is where the employee's money goes in after the tax is already deducted. That's the only difference. So one, no taxes deducted. The other one, the tax is deducted. Now that we've talked about all the positives about 401ks, let's talk about the negatives. First of all, I mentioned this before. In the employee world and the employer world, they are known as golden handcuffs. And let me just tell you this real quick. The reason I know this, I have lots of people who work for me that are employees. But when I was setting up my tow company, I talked with ADP and their thing, and I'm like, you know, what's the upside for me as an employer doing a 401k? And they're like, well, really, there's not much upside other than offering this as a benefit to your employee. But you could make it so that they can't take the money out if they leave you. So that's a negative. Or you could make it so you don't match anything. That's a negative. And they're golden handcuffs, meaning that you might have to stay there the whole time to get your money. You hear about these people chasing their pensions till they're 70. Stop chasing your money. That's a big negative on a 401k. But you may end up paying more money in taxes after all. Let's go through that. The big appeal of 401k plans is they offer a tax shelter. As long as you leave the money untouched and you don't take any money out, you're gonna pay no taxes. As long as you don't owe any money on the gains that you've made. Yet, once you wanna retire, that's when the tax man says, I'm done taking it out of your paycheck, now I'm taking it out of your 401k. So once you start making withdrawals, once you start taking money out, that's when you're gonna start paying taxes. You'll owe income taxes on your contributions and income taxes on your withdrawals from your gains. So the downside is if you're making more income when you retire than when you were contributing, then you're gonna have a higher taxable bracket, which means you're gonna pay more money in taxes when you retire because you're making more money through your retirement. If you're earning more when you retire than when you actually contributed the money in, you're gonna pay a higher rate on that money. And one big negative, contributions follow a schedule regardless of market conditions. And they'll call that dollar cost averaging, which means that you're putting the same amount of money in every month, that you're taking the swings down and you're taking the swings up. But really, market timing is everything. You're not allowed to time the market. Of course, you should never try to time the market. That's what experts will tell you. And experts base this advice on dollar cost averaging. The basic idea of dollar cost averaging is that you buy a steady amount consistently for years and years, for months and months. At the end of the day, it all equals out because you're rolling it in, month out. You buy in the highs, you buy in the lows, you buy in the highs, you buy in the lows, and overall, it all works out in the end. Plus, most people don't have time to watch the market. When's the last time you even watched the market, looked at your 401k? I want to know. Comment below. Do you have a 401k? Yes, no? And if so, how often do you look at the statements? And if you're a DIY investor, like a do-it-yourself investor, the 401k really doesn't allow you that flexibility to be that way. You kind of just got to take whatever you get. I know people with 401ks all the time, they're like, wow, I did so great. How'd you do so great? I don't know. I just did great. That's kind of their investment strategy. As long as the market's going good, I'm doing good. As long as the market's doing bad, I'm doing bad. But guess what? Who cares? Because my employer's matching it. Or are they? Have you actually read what they're contributing? That's a big negative of 401ks, is that you do not know sometimes what the restrictions are of your 401k. Which brings me to my next negative. You may be paying more in fees than you need to. Like, maybe you're paying so much fees that you wipe out your gains. Employer-sponsored 401ks are heavily regulated, and that's a good thing. Your employer or the company that you work for cannot put vesting requirements on the money that you invest. But it might mean the administration of that account is going to come with some high fees. The bottom line is there's so many hidden fees with these mutual funds, with these 401ks, you're not even going to be able to make heads or tails of it. You're not going to be able to figure out where it came from because the laws that are passed do not allow you to. The bottom line is they're hiding the money somewhere and you're never going to find it unless you're in the know, and we're not, and most people aren't. And really the only people who are in the know are the people that are selling the mutual funds. And let's go into what mutual funds actually are. A mutual fund is a freaking stock of other stocks. It's a company that's sole purpose is to buy other companies. So what's the worth of that company? It's really nothing. It's really a bunch of guys that are going and taking your money, investing in other stocks that are then taking your money and investing in other things. So it's totally diluted. Another big negative. And ideally, your employer did due diligence when investing in their plan, but they may have just picked something out of a hat. You don't know what you're gonna get. Therefore, you're stuck with something that you didn't want to begin with. And most people really don't understand their 401ks. I know when I was at Intercom Radio, I had a 401k, and honestly, the only thing it was good for was a savings plan, and that's about it. Your investment choices are limited. You can't choose exactly what you want to invest in. You might be dealing with your employee that says, hey, you know what? We're dealing with ADP, and ADP has these companies that they deal with, and that's the companies that you're going to choose from. Or we work with this mutual fund, and they're working that way, or we work with stocks, or we can't do stocks, but it's limited. You don't have a la carte. You can't get what you want. You're only going to be set up with what your employee wants. Last but not freaking least, you just can't easily touch the money before you retire. And that's what the golden handcuffs are all about. So you're shackled to your job, you're at your computer, you can't go anywhere. Get out of those golden handcuffs, stop investing in 401ks, take advantage of what we're talking about, subscribe, hit the like button, share this video with a friend, and just get started investing in real estate. That's all I want you to do. Peace.